All right, you guys. I have a couple of questions, but again, I really would kind of like this to be interactive, and feel free to interrupt, ask questions, or whatever. But I'll tell you the one thing that we got the most questions on, and this is probably one of the sensitive issues for our brokers in our audience, is how you guys are dealing with virgin groups. How do we deal with the fact that there are employers out there that may have 200 employees, but they've been offering benefits to 30 management people, and all of a sudden, under health reform, they have to take all of those people who qualify as full-time employees and absolutely offer some health benefits. Anyone have any thoughts on how you're dealing with that? Adam, you want to?
Yeah, I think, excuse me, I've been losing my voice as well. I think one of the most important things with these virgin groups is to start the conversation with the group earlier in the process. Because from a stop-loss point of view, and I think everyone up here has the same viewpoint, if you send in the census of 200 employees and then the actual enrollment comes in at 40, the demographics of that 40 people is going to be significantly different than how it was rated on the 200, and it's going to cause issues with underwriting. Whereas if you guys can start the conversations early with the client, talk about what the premiums would be, talk about what the participation would be, and get a better idea of how the quote should be submitted, I think it'll get a much more significantly accurate quote from the stop-loss market.
I'll hit on that as well. I think the other fundamental issue is that there's not any data to go off of too. So how are we rating these groups? I mean, what are we going off of here? I mean, I think Adam hit on a good point. Let's get started earlier in the process, and now we can talk about individual underwriting and some of those types of things to you know, get as accurate of a quote and as aggressive as a quote as we can right from square one, rather than, you know, shooting from the hip. So.
I'll add something too as well, is that I'm sure everybody up here is seeing a fair amount of those groups that are virgin groups, or like Tom said, are starting off at 40 and going to be adding maybe 100 or 200 people onto the plan. And we're even actually seeing groups that are a couple thousand lives that are virgin groups. So, you know, we can, and just like Johnny was saying, that it's a manual quote, but absolutely send them in. It is an option for stop loss. So don't think that just because they don't have experience that it's a no-go. So it's an option, send them in, and there's stop loss for it.
Yeah, we've looked at them as well, a lot of them actually, and I think Adam mentioned it. It's the thing is, you're getting a full census, but you have no idea how many people are going to accept. And I think to understand that on the front end, it could change significantly once you get the final count, because really all you have to do is offer it to singles, and all you have to do is offer it. Doesn't mean they have to accept it. So you could end up 500 employees out there and 50 of them end up accepting it, and it's going to be a total different group.
So there's really there's no way of knowing then, right? I mean,
well, I was just going to add, Tom, that one of the things that we've been talking about for the last 2 days is information. And one of the things I think employers, now I'm not so sure about the 2000 Life group, but if you know the risk, you can put your hands around it. So we're actually offering underwriting services for employers that want to go through the process of having their employees fill out questionnaires. And then you can really put your hands around the risk.
Yes? Isn't that impacted by the auto-enroll provision? You get up over a certain size, are they required to auto-enroll everybody?
Automatically enrolling everybody, but
not in the ERISA plan, not next year. That's one of the advantages of self-funding next year. You can still underwrite.
I'll tell you another issue that we have grappled with for a long time is gaps in coverage between your SPD and the contract, your stop-loss contract that you're being issued. In other words, there may be limits or exclusions in the stop-loss contract that may not match what you have in your plan document. Doesn't happen often, but sometimes you end up having a claim that's non-reimbursable because you just didn't know that there was a gap in coverage. How are we as an industry dealing with that? How are we, kind of helping the employer understand if there are gaps in coverage? And is there a time that we envision actually adopting the plan SPD as the contract for stop loss? Steve, you want to answer that?
Well, yeah, I mean, I think knowing, for the underwriter standpoint, knowing what you're going to have in your plan document at the point in time of underwriting is critical. I mean, I think as you're having these conversations, getting a head start on those conversations, you need to think that both the broker and the employer group need to think like the risk taker. We get a lot of this activity, and we get a census, and we get a plan of benefits, and that's all we're working with to quote. And I just encourage you to, if you're going to incorporate, having the conversation, if you're going to incorporate some of these cost containment measures that we've talked about in the last 2 days, that's helpful for the underwriter to know. If you know other things about your group that the underwriter would want to take into consideration, share that. Don't send us just a census and a plan of benefits. Tell us how you're going to manage your plan in the next year, and that's going to make the underwriter more comfortable. So some of those things in the plan document.
And do any of you here representing your companies actually adopt the SPD as the contract?
Yeah, in some cases,
I'm going to pull the microphone close.
In some cases, what we've done where we've had a TPA that we've got a high number of cases with, we'll look at their plan documents and almost develop with them what their boilerplate plan document is. And at that point, we'll go through it, pre-approve ahead of time. And as long as we know that there isn't going to be, materialistic changes in the plan document from one case to another, we'll agree to mirror their plan document.
Can you define material differences?
I mean, it's on a case-by-case basis. But the point of the matter is, if we can look at it and we're comfortable with what's in there, in the coverages and exclusions, we'll go ahead and mirror it on every case as long as we know there isn't going to be a significant difference, and we agree that this is going to be the plan document that you use for each one of your groups.
Right,
so that's one of the ways that we've gotten around
we should
that.
talk. We need to talk about that.
And I'll just add something onto that too, is that, like Tom was alluding to, your self-funded medical plan is so different than every other coverage you have on your group. Group life, STD, because that is determining to the employee what's the benefits going to be covered. SPD is going to determine to that employee what's going to be covered, but then, like Tom said, the stop-loss contract is then going to determine what's going to be reimbursable. So you want those exclusions in your contract, because a lot of brokers don't understand that, and it's not a good day when you have that claim denied by your stop-loss carrier. So as much as you can, you want your stop-loss contract to mirror your SPD, and I say the big thing that you want to look at is your contract exclusions, your stop-loss contract.
Let me ask you, because I'm sure all of you have answers to this, but how many of you actually have read your stop-loss document? And compared, do you actually do it? Because we have a lot of people, I'm sure, that don't, and I don't know for sure. I mean, obviously a lot of, you know why? Because you're smart people, because you're at Cypress University. That's why you do that. There's a lot of people out there, I believe, that just don't do that, right? Have no idea what's in their contract.
I mean, some will have 25, 30 exclusions in their stop-loss contract.
Yeah, most policies are not that long to read, so they're not that difficult. And from companion standpoint, we always insure the document. The only exclusion I can think of in our policy would be in a document is for experimental stuff.
Yeah.
Yeah. What we do is when we get the plan document in, we review every plan document. Our claims department goes through every plan document, and they try to identify any type of gray area ahead of time and get the conversations going before any type of issue. That's why we always stress the importance of getting a plan document in as quickly as possible. We know when it's a new group coming off fully insured, it takes a little bit more time to get it written. We always stress the importance of getting the plan document in so we can look at it, so we can get ahead of it in case there's anything that could cause a problem further down the road.
Yeah. Yeah. I have more questions unless you guys want to go. Yeah.
One part, many of you have exclusions for accidents due to drug or alcohol.
Anyone have exclusions for
No.
drugs or alcohol?
Not here.
See it in plan documents, but we don't have it in stop-loss.
Right. And the other thing is on the other side of that, you guys and your companies read the plan documents to make sure there isn't any contradictions.
I can speak for us. We read every one. I have a department that does that.
That's
So,
pretty
Chris,
well
you don't
universal.
read the plan documents? You're
I
not
don't.
involved in that?
I mean, I'll look at
That's
the benefits
incredible.
picture.
I think we as an industry have done, I think it's universal. It's talked about at every conference. We are trying very hard as an industry to mirror the plan document.
Yes.
And I think it's standard practice that plan documents will be reviewed, and it's a partnership. But we are certainly going to make it known to you if we feel there's a discrepancy between the plan document and the stop-loss policy.
In fact, when you amend your plan, we'll send you a letter saying that we've acknowledged the plan amendment and it's accepted, and you'll get a formal letter for that.
There, you should be aware, brokers in the audience, on March 27th of this year, a lawsuit was filed. I forget what state, maybe you guys might know. It's Express Oil Change versus A&B Insurance Services. A&B is an insurance agency. I want to say they're in Ohio or something. I don't remember what it was. But essentially, Express Oil Change is suing their broker for lack of coverage in stop loss matching their SPD. They had an exclusion. And the Express Oil Change is like, well, we didn't know. You know, it was the broker's responsibility to point that out. And the insurance agency asked for a summary judgment and or a dismissal, and the courts said, no, we're going to try this. So this is important, I think.
Yeah, I think that's the piece. It goes beyond just the price, and that's where the value comes into play. As regarding how you're going to handle the policy, how you're going to handle the plan review, how you're going to handle claims. You know, Tom talked about it. It represents about 10%. You know, the price on the front end is key, but how is everything handled on the back end is probably even more key, and it's important to understand that as you work with a stop-loss carrier in a relationship.
Bob, you got a question? He wants to know how many people up here actually insure the plan document.
I can honestly tell you in my 14 years, we've never declined a claim that wasn't described in the plan document.
It's because they work with Cypress Benefit Administrators. See, it's all connected. Everybody agree with that? Everyone's.
I would agree with that. Yep. It does happen, and the lawsuit that you reference is an example of that. But I do think it's a testament to who you work with on the stop-loss side. But I can tell you, every time we issue a policy, and I think that's standard amongst this group up here, we're ensuring the plan document. We're mirroring the plan document, and regardless of what the language is in the stop-loss policy, we will defer to the plan document in terms of claim decisions.
Absolutely.
There's been a lot of consolidation in the stop-loss market in the last 10 to 15 years as well. And I think what you're seeing now is the stop-loss carriers that are left are around for a reason. And I think in general, we do a much better job as an industry in paying claims, doing it on a timely basis, following the plan document, not trying to nickel and dime claims. I mean, if you do that for very long, you're not in this industry for very long. So I think it makes sense that all of us that have been around for quite a while in this understand that, and it's you know, I think that's important to note that as well. So it's not to say there isn't problems in our industry regarding plan documents and paying claims and those types of things, but I think in general our industry is doing a much better job than maybe it has in the past, and the players that were around 15, 20 years ago are no longer around that, you know, handled claims in a way that created you all problems on the claim side of it.
Yes, Ann.
Could you let us know what size groups are your sweet spot?
That's a good idea.
All right.
She wants to know what, for each of the carriers, what size groups or size deductibles are kind of the sweet spot.
I'll go first. We go down to 25 lives on our traditional stop loss. We have a fully insured look-alike process called level funding now that goes down to 10. We haven't written anything that small yet, but that's an underwritten product. And then we go all the way up to whatever. But I would say our average size deductible is probably around $150,000 to $180,000. But we go all the way down to $20,000. We kind of build our reputation in the small market, but we've kind of, as we've grown, we've gotten bigger groups.
For Optum, our minimum lives is 50, but in terms of a sweet spot, probably the size group that's on average, I'd probably say, and I'm kind of going off the top of my head here, probably the 250 to 500, but at the same hand, you don't know if that's your sweet spot, if that's really the most groups you're going to get in, that's the common size. But you know, down to 50 lives, 20,000, and up to $1 million specific. But you know, for us personally, we like that. Let's say $50,000 specific up to about 150 is probably our spec sweet spot.
IMG is an equal opportunity underwriter. We underwrite all size groups. But that being said, we do go down to 11 lives and kind of have built, as Chris said, we built our reputation writing smaller groups as well.
Barton Insurance Group, we start at 25 lives on new business. On renewal, it can be as low as 20 lives. like everyone else, we'll quote it as large as we can be competitive on. I'd say our sweet spot is probably in the 25 to 500 lives. Our average spec is somewhere between, I don't know, 37 and 60,000. We've always prided ourselves on being creative solutions for stop-loss needs, so that's where our kind of niche has been. But
So you're saying 37,000 is like a popular spec deductible?
You know,
I'm not sure we've ever written a 37,000 spec deductible.
people pay attention when you use strange numbers. If you ever look in a community and it's a 13-mile-an-hour speed limit, you notice it more than a 15. So when I say $37,000 deductible, everyone's like, oh, he said 37.
Got
It
it.
works.
IHC Risk Solutions, standard security. Our minimum number of lives is 25 and a half. 25.
There you go.
Spec deductible really starts at 25,000 on up. Our sweet spot is probably groups in the 75 to 300 life range. Average spec deductibles tend to run in about the $35 to $100,000 range. So the smaller to medium-sized cases is kind of where we tend to play at.
HEC Life, we don't play favorites either. We're kind of all over the board as far as group size. We go all the way down to $20,000 spec and 25 lives. Our average spec deductible is probably right around $80,250 and odd cents. So no, and then and we go all the way up, you know, to whatever spec deductible a group is looking for. We do handle groups a little bit differently. Under 200 lives that are currently fully insured and don't have experience, we have the ability to underwrite those as well. So the concern right now, I think, is on the state side and the regulation and what's going to happen there. And so we're a little cautious of the really small groups. I mean, we still have groups in place that are at 15 lives, 12 lives, that sort of thing. But definitely monitoring from a state standpoint to see how that progresses as well.
East Coast underwriters, our smallest would be 25 lives. We go up, you know, really as high as they go, but sweet spot's going to be 25 to about 300, 350. Really our niche has been 25 to about 200. We've got some transitional reinsurance products, aggregate only especially, so it kind of falls right in that wheelhouse. We really like to help employers kind of, you know, bridge that gap. Lowest spec would be 20K, and you know, like I said, falling in that niche, probably about 20K to about 100K. So, yeah.
The question is lasers. All right. And I would add, is a laser a good thing? When is it a good thing? So yeah, who wants to kind of tackle that?
I'll touch that one.
Does everybody know what a laser is, by the way? Rob, why don't you just make sure everyone knows what I would imagine.
It sounds really cool, but essentially, if you have a group spec for a group, $50,000, and you have a known ongoing claim at renewal, and if you expect that claim, we have nurses on staff. They'll look at the claims, look at the treatment plan, and estimate that from what they know. And again, it's an estimation that they think the claims are going to be $200,000. If your premium is only $100,000, to pay for that, you know, it'd be a loss. So when it's a known claim, some of the carriers in the industry will apply a higher specific to that ongoing claim that's higher than the group specific. So that's a laser. When they're good, they can be good. I've had it happen in the past where a laser has been put on a group and that person has gotten off the plan either by dying, unfortunately, or they terminate employment and they're no longer on the plan. So in that situation, even though there's a higher spec for that group has not had that claim and paid those additional dollars amounts. So in that situation, a laser can be good. With Optum, we do have the option that you can pay a little bit more and have a rate cap and not have a laser at renewal. So again, you can have that, but what we found is a lot of times that the employer group, you know, the brokers may like those, they may not. The client goes, what, I have to pay 5% more? I don't want to deal with it. I'll take the laser. So the option is there, but it seems like the employer groups don't want to pay more to have that protection. Some do, but then again, some don't.
Anyone else?
And I'll just add that I've been in this business for 14 years, but 15 years before that I was a TPA myself. And back when I first got into the business, there was no such thing as a laser. What happened is as claims became catastrophic and ongoing and large dollar amounts, it was either the employer could pay additional premium or we could figure out a way to help him qualify that risk. Now, I think all of us up here would take the premium. But most employers aren't going to want to do that, so there has to be a better solution, and that's how lasers were developed. Now, I can guarantee you that we've all set lasers that never really hit, but sometimes you hit lasers and they blow right through them. So it's really, there's still a lot of unknown out there.
I think one of the things in the market about the laser, and it doesn't get discussed because it's not popular with whichever MGU brings it up, but I'm going to. When a laser is set, usually an in-house nurse or a nurse consulting firm reviews the medical condition of the person for the ongoing claim, and they say, this person is going to spend $200,000 in the next year. If you're a group with a $50,000 deductible, the appropriate laser is really the $200,000 of claims plus the $50,000 deductible. It's not sellable in this market. What we're doing when we're placing a laser is we're pretty much saying we're lasering this individual at $200,000 and we're pretty much giving them a $0 deductible because we're lasering the one condition they have, and then they're getting a pass on the rest of the plan. This is talked about at every SPBA. Every conference we go to, they talk about how do we get rid of lasers and how do we go back to, just premium and working through it, and that's something, that everyone's working on. We, like everyone up here, I'm sure everyone here offers a no laser product. Ours is free. We don't charge a premium upsell for it. We can talk more about it, off the panel if anyone's interested. But everyone here offers some type of no laser panel, and everyone here is looking for a way to solve the problem when lasers come up because we know they're not popular and it's an additional liability for the group.
Yeah, and for what it's worth, I don't dislike lasers. Because I think it's a tool that people can use to mitigate their fixed costs. And we did a study, this is not real recent, a couple of years ago we were kind of wondering how stop-loss carriers set lasers and whether or not they ever come to fruition. And we had an interesting, we took a look at an entire year's worth of lasers, and we found out that about 40% of the time those people hit their laser amount. 40%, which made me reach the conclusion that if a stop-loss carrier is giving you a laser, you should take it because their premiums are going to be lower than they otherwise would be. And number two, a lot of times, this is just my opinion, I'm not an underwriter, God knows, but a laser is often set on someone who's already incurred all those expenses. The bulk of the expenses have been incurred and paid for, and they're either going to die or they're going to not have that kind of experience. Is that right?
Yeah, I'd agree that for our book of business, it's probably less than half of the time. But one thing that makes in these days the laser a little more predictable is when that person is on dialysis, and it's a chronic condition. They're not undoubtedly going to pass away, and you know that the dialysis can be anywhere, and I'm sure everybody up here has witnessed it, $30,000 to $50,000 to maybe $60,000 a month. It's easy math. 50,000 times 12. It's not hard to do the math. So with something like that, it is very predictable what the claims are going to be. They could obviously have a transplant.
Wait, Rob, would you do the math for us then?
It's 220,000.
Wait a minute, what?
Yeah, exactly. It's 600. So in that situation, it can be very predictable. But in other things, cancers, those sort of things, it can be a little tricky to try to estimate what the claim is going to be.
I would just add to what Tom had said about lasers and lasers hitting. On our block of business, it's probably about 40 to 50% of the time they hit. And it's for various reasons those lasers don't hit. And if you don't laser, you're going to put it into the premium. And if you put it into the premium and that risk goes away, you're still paying the premium on that group. And then you're also starting at a higher level on the renewal next year. And very rarely does that go backwards. So it's just it's just another way to manage the risk. I think the key is understanding it, understanding what's out there, and getting the information. obviously the information is the key. We have nurses in-house that are looking at this, but, depending on the information, sometimes it's just pure, you got a dollar amount and you got a diagnosis, and they're just going off industry standards what that is. So, we'll do everything we can to try to find out what's really happening with that individual. If you guys, want us to talk to HR people, that sort of thing, that's something that we're willing to do to try to figure out what that actual risk is going forward.
I think probably the most dialogue that we have with our TPA partners is coming at renewal time when we have a claim that we're trying to figure out what the risk is. And we're actually on a daily basis trying to get updated information from that person if they're confined, if they've been released. All of those things is just like we've been talking about for the last 2 days. The more you know, the better you can evaluate this. And it's sometimes hard to get hospitals and doctors and nurses to communicate with you to give you all that information on a timely basis.
I would only add that, again, the problem is next year at renewal. You don't know today what's going to be there next year in the way of an ongoing claim. And if that's an uncomfortable liability or uncomfortable uncertainty on the part of the employer, there are products out there. International Medical Group has a no laser policy that also includes a maximum rate increase, and there are others here that have said that they also have no laser products. So again, it's our industry is responding. There are times when lasers make sense, there are times when they don't, and there are products available that will guarantee that you don't have a laser at renewal.
Sandy.
In the old fully underwritten, fully insured markets, the philosophy was after about 2.6 years, the underwriting is worn off, and if that group left, yay, bravo, you probably are saving money. We try to say to clients, stick with a stop-loss carrier forever, because you're going to have peaks and valleys, you're building a relationship, you want to maintain that relationship. Do you decide after 2 or 3 years you're better off jettisoning them and starting all over again? Or do you have a strategy for retention? What's your approach to retention?
That's a great
question.
I
can tell you from my perspective, and I think these guys can all speak for themselves, but I actually have groups that I wrote the first year I worked for Montgomery, 14 years. And when they have been clean and good and they have a claim, we try and consider that because they've been with us a long time.
Just to add to that a little bit, for us, we look at it a couple of different ways. One, with any group we have, we want to try to keep it as long as possible. That being said, excuse me, we look at a couple of different things. Is it a group with a TPA that we have what we call a block of business with? And if we've got a group that's not running well, and hasn't for a couple of years, but the overall block is run fairly well for that TPA, that helps us look at that particular case at renewal and say, they're running poorly, but the block overall with this TPA, it's a good partner of ours. What can we do to mitigate some of this increase? What can we do to, help out the group, but also help out the TPA retain the case? So it's really more about a relationship and trying to look at it beyond just that one case. Now, if it's a situation where we have just one case, it's with a TPA or a broker, and the group's run poorly for several years, and the loss ratios are well over 100%, it makes it a much tougher situation for us. Ultimately, we all have our own particular target in terms of what we have to reach in terms of a loss ratio in a group. But I don't think any of us look at this and say, after 2 years or what have you, regardless of what the loss ratio is, that we want to get rid of any group or look at it from that perspective. I've never heard of that. I've been in the business for 17 years. I don't think, I've ever heard of anybody really looking at it that way. Again, for us, I think it's more about trying to maintain a long-term relationship with the producer that we're partnered with, whether it's the TPA or the broker, and looking at it from a little bit bigger picture perspective for these individual groups that are not running well at a particular renewal.
I think you hit on something really important. You said peaks and valleys and looking at it long term. I mean, essentially, self-funding should be a long-term solution for your group health plan. So, we take that into consideration with stop loss, and by no means would we want to jettison a group out if they've had a poor year from a loss ratio standpoint. You want to look at it long term, and like Chris said, we have cases as well that we've held on to, basically since our inception, and I think it just goes to show that you have a long-term plan, kind of take that into account from a stop-loss perspective, and groups are going to have good years, groups are going to have bad years. So,
and some of it is our responsibility as a TPA too, to kind of act as the conduit between the group and the stop loss people, and saying, look, you can't get 100% of your money back this year. Let's talk about it more long term, right? That's kind of the strategy.
But I would add to that too. I mean, our goal is to renew our business, and we look at various factors as well. But I would say one thing that we definitely look at is what are we getting for rate increases year over year. You know, our goal is to get a fair increase year over year, and it makes it much easier when you do have a bad year to help renew that case fairly. You know, if we're not getting increases or going backwards on the case, and then there's a bad year, it's probably going to be looked at a little bit differently than if we were getting fair increases over time as well. So,
okay. The question is, as we're looking at partnering with a stop loss carrier, maybe just in a specific geography where we're at, do we look at their experience in one area or another? Industry, geography. I guess the answer to that is kind of, I'm going to hedge on this. No, basically. I mean, what we have been successful at doing is identifying people with whom we want to partner because we have had good experience, and we've got millions of dollars worth of experience sitting at this table. That said, an interesting phenomenon, and maybe this is how you guys can answer this, an interesting phenomenon happens in our business, and that is we find one stop loss carrier who's horrible in one state and awesome in another, just because their underwriting manual allows them to be that. So I think it's kind of works itself out organically that way because we're getting quotes, on spec rates and ag rates and attachment point factors that are really great in one place or another. Why is that? Can you guys tell me why the hell you are different in different places?
Well, I think basically there's more than one manual out there, depending on the manual you're using, and your ability to feel comfortable about where that case is located and what they do.
So do you use different manuals?
I think there's probably different manuals at this table. Yeah.
No, I mean you specifically. So Montgomery Management has.
We subscribe to a manual. I'm not sure which one it is, but there's a Tillinghast. There's a number of different.
So
manuals.
Why is Tillinghast say to you, you consistently in, the state of Nebraska, your rates are non-competitive, but in the state of Oregon, you are?
It's probably more related to a zip code thing, and again, I'm going to hedge a little bit on this because I'm not an underwriter. So.
I'm with Chris. I mean, I think really is contingent upon the zip codes. I mean, certain states, you could be, there could be a little bit more no man's land. I think we said Nebraska. I mean, there's likely to be.
Wait a minute, are you saying that people from Nebraska live in no man's land? No, this is East Coast underwriters. If you ever get a quote, Nebraskans.
Actually, Nebraska's a good state. It is a good state, and I'm not lying when I say that. Please believe me. But what I was referring to was certain pockets of certain states being more populous than others, and that kind of dovetails into there being more industries. You get more concentration of certain industries in certain zip codes, and you kind of are able to see that trend, if you will. So you're factoring that into what Chris said about the manual, and it's kind of a two-pronged approach. So I guess I'm going to kind of hedge here too.
I think when it comes down to manuals, I could go into it in detail. I'd need a whiteboard about the size of this backdrop and some dry erase markers.
And we'd prefer not to hear it.
Basically, it would start with the lunacy of actuaries. And I can honestly say that because my father is an actuary and he's a lunatic. So what we have when the manuals are being developed, they gather claim costs from every zip code, and then they crunch the numbers over and over again. And we've got a manual with an actuary, and the guy looks like Bob, the painter who used to be on PBS. He's got the crazy hair. We're fortunate enough where we can adjust our specific manual to what we have seen specifically, so our manual is then adjusted even further. When it comes down to why is one MGU different than another in a certain zip code, it comes down to the lunacy of the actuary who made the manual.
Great.
Yeah, and I'll just add one more thing to that, is that everybody up here, their manual, like's been said, it's actuarial driven, but for every 3-digit zip, there's a factor for that area. Maybe here in Vegas it might be 0.9. In Omaha it might be 0.5. From there, it's also there's a network factor. So when you start combining those factors is when you start getting those variances in a rate. So everybody up here, you might be certainly competitive in a certain state or a certain city. and you go to another state and your rates are really high. And that's just the way the quirk of the manuals work.
Okay, so there is no good answer to that.
No,
question.
there really isn't. I will just add, though, that I think we can all, everybody will agree with this up here. I don't have anything that's 100% a manual. So I think our block of business probably averages somewhere between 75 and 80% of the manual number that would come up in a certain area, based on network, based on things that are put in the plan to control cost.
All right, with this, right back there.
You mentioned PPO.
Oh, see, now you just took that guy's question. I got my eyes are crooked, So.
I didn't hear you mention plan design. This is one of my pet peeves. I take over groups on a $500 deductible plan with literally no out-of-pocket expenses. And in 2 years, I transitioned 95% of the group to a $3,500 deductible HSA offer. And there's no comparison in my mind between utilization levels at either of those places. Now, you're at a high-risk level, but I can't get the ag factors off of what they were when you had a $500 deductible, which drives my premium on the plan, which drives, I can't show enough difference.
You should be able to, first of all, whether you have a $5,000 deductible or a $2,000 deductible doesn't determine whether that claim is going to be $100,000 or $200,000. So on the specific side, I agree with you. On the aggregate side, if you're going from a $500 to a $3,500 HSA, there should be a significant discount. And if you're not getting that, then
this is being filmed, Sandy. So
you need to bang the drum a little bit, because I can tell you that we would do that. And I think everybody would say that up here.
On the specific premium side, I believe there's about from the richest plan design to the weakest plan design, there's probably maybe about 10% swing in the spec premiums based on plan design. On the attachment point is where you're going to see all the changes. And if you're, like Chris said, if you're not seeing them, then something's wrong.
Yep. All right, we do have another question. Oh, you mean you're from no man's land? I can't believe you made it. But you bring a horse and buggy here?
I don't know anyone up here who does it in addition to the specific.
No. Yeah.
All right,
and there can be differences in specifics between opinions of nurses and in the information. That's not uncommon for one of us to get a piece of business over somebody else because our laser was a little more competitive, and vice versa.
And also too that from my experience, the underwriters who are underwriting the case, the nurses might give them a range of what they think the claim is going to be, but it's, underwriters are human, and if they had a case that they underwrote that was a similar condition that blew up huge, they're gonna if that just happened the day before, they're probably gonna go, nurses said 200, this other claim blew up, I might go a little higher. So the underwriters are human, and they will react to, let's say, something they had in a similar situation that might have, in the opposite way. If it happened that it wasn't that big, they might go lower, but if something went bad, then they might go a little higher than what the nurses estimated.
All right, I got about 10 minutes. I know there's some more questions, but I just want to get to one thing before this gets a little bit too late. Steve from IMG said something earlier about stop-loss carriers and MGUs responding to market pressures and coming up with new products and services and different ways of doing things. And one of the things I wanted to do, because this is a great frustration of ours as a sales organization, I want to sort of give you an opportunity to hear from these guys about some new or different types of products that may be available to you, if you guys don't mind giving away industry secrets, because you know how secretive this industry is. But our frustration is that often we get opportunities to sell stuff that's different than the traditional stop-loss policy, yet it never gets to the ears and eyes of the client. So we want to talk about that. So you guys willing to kind of sort of say whatever you want to say? This is like your sales pitch opportunity, but make it like 1 minute.
I hit on this briefly.
several minutes ago, but as I was mentioning before, we have an aggregate-only program that's a really great bridge product, as I like to refer to it as. So on cases that are small to medium size, so 25 to maybe 200 lives that are coming off of fully insured for the very first time. So maybe they've been fully insured for 20 years. They've just now decided to maybe take the leap into self-funding, but they're a little apprehensive. They understand that there's some risk. They understand that there's going to be a little bit extra work. So what we basically do is we underwrite the case as if it were a fully insured, give them aggregate-only stop-loss policy, and essentially they're just cutting one check each month like they'd be doing to a fully insured. We're actually using the attachment point factors to process those claims, and they're paying their premiums as normal. So has very similar feel to a fully insured policy, but again, it's a self-funded plan, and really the goal is long-term, third, fourth year, while they're in the aggregate-only program, then transition them over to a traditional stop-loss policy. They've got their feet wet. They understand what they're getting into. From an account management perspective, they're ready. So that's really our big hitter. And in fact, Drew and I from Cypress, we've recently come up with a somewhat similar product, but it's actually more of a level premium that incorporates a traditional stop-loss policy. So there is a spec in an ag. They're using the attachment point factors to, again, fund the claims, but we're giving a little bit of discretion on how much they want to fully fund each month. So they might not be comfortable fully funding that entire corridor. We say, hey, what are you comfortable funding? And then kind of take it on a case-by-case basis, and stop loss kicks in if they blow through it on any given month. And again, a nice little transitional product to get them thinking. So sorry if I took up too much time.
Yeah,
guys.
that was more than a minute.
That was like 2 minutes. I'm sorry?
It's the client is ultimately responsible for the claim flow, so that money,
right?
The premium or the premium equivalent goes into the checking account,
right,
of the client.
A bank account is used, and we have view-only access to that account. So if they do blow through their monthly attachment point, ECU kicks in within 24 hours and starts footing the bill.
And they keep the reserve.
Oh, and on the new product, I'd like to just also mention that they keep 100% of the reserves at the end of the year. Thank you.
We also have a underwriting methodology to deal with fully insured groups. Obviously, the challenge with fully insured groups is you can't get experience, and so for 200 lives and less that are currently fully insured, we have an underwriting methodology and approach to be able to underwrite that and hopefully move them over to self-funding. Obviously, I think we're seeing a lot of that right now, and it's only going to increase as we go throughout the rest of the year. The other thing that we've just developed and rolled out is a captive product. Obviously, that's a little bit different. You're starting to see the captive word out in the marketplace a lot more. It's not for everybody, but it is a turnkey approach to the captive world. It's producer-based, sell, and then we've recently opened it up to do one-off cases as well. So that's something that if you desire more information on that, want to have a discussion, we can definitely talk that through as well in more detail.
We've got a couple of new products that we are in the process. We've rolled one out. The other one's going to be rolled out here fairly soon. The first one is a self-funded transplant carve-out policy. And basically, you're all familiar probably with the transplant carve-out programs. They're fully insured. There's a couple of carriers out there that have been doing these for a number of years. But our approach is going to be a self-funded transplant carve-out. It's going to run about 20 to 50% of the cost of what a fully insured transplant carve-out is. It'll basically mirror the stop-loss policy, so it'll pick up at the spec deductible. And it's the backbone with the transplant network will be LifeTrack. So we partnered with LifeTrack on that. And we're real excited about it because I think we're probably the only one right now that's offering a self-funded transplant carve-out. And there's no underwriting or anything like that. It follows the disclosure process with our stop loss policy. It also can be sold with our competitor stop loss as well, but there will be a 12-month pre-ex on it in that situation. So that's one of the products that'll be coming out probably within the next, say, month or two. We're real close to rolling that out right now. The other one is we are in the captive space as well, have been for about 1.5 to 2 years. It's called IHC Captive Solutions, and we're in the process of partnering with certain TPAs. Cypress is one of them that we're partnered with this product. And again, it's geared for the fully insured marketplace for these groups that are looking to get into self-funding but want to remove some of the volatility in self-funding. Our product is going to be geared for really the 50 to 500 life groups. And so if you've got an interest in that, we can have a separate side discussion about it. But again, we're a little bit selective about who we're partnering. We don't want to just flood the market and work with a bunch of different people in a given state. So, but that is definitely out there right now, and we've been writing that for quite a while.
All right, I'll try and be brief since this is getting like a presidential debate with everybody getting their words in. We can write fully insured group takeover with no claims experience. We'll do individual underwriting. We say 100 lives or lower. We can go a little bit over 100. Like I said before, we have a no laser product that does not have an additional need for premium. More details available off the stage, so I don't give all the secrets away. We have, as we spoke yesterday, as Tom, as one of the presenters, talked about how keeping the clients involved after a claim hits the spec level is important, because it's important on your renewal to control costs. We have also a product where if the client is willing to stay involved after the spec deductible, it reduces their premium by 20%. Again, more details are available off the stage. I mean, those are some of our products I think make us a little bit more unique. We try and be very creative. Instead of lasers, if there's a group with multiple lasers, we can write an aggregating specific on named people, so we can kind of bundle multiple large claimants together and give them one deductible for multiple people. It's a creative way to avoid having like 3 lasers. And hopefully that was under a minute.
Yeah, not bad.
At International Medical Group, we have put a lot of effort and thought into trying to respond to that part of the market that is in the greatest need right now, and that is groups that are going to have fewer options as PPACA is fully implemented and are fully insured today. And we have developed a product that we believe takes the what-ifs out of self-funding for those employers that are fully insured and have not considered self-funding before. We talked a lot about those what-ifs this morning. Lasers. We have a product that does not laser and has a maximum rate increase to it. We've talked about terminal liability. If you're fully insured, you're on an incurred contract. One of the what-ifs of self-funding is what happens when I want to no longer be self-funded, or if I can't be self-funded. We have multiple terminal liability options available, from a true terminal liability option that is invoked only if it's needed, to 1215, 1218, and incurred contracts. We've talked about the what-ifs of cash flow. So if you like the in the fully insured world of being able to write one check a month and then not worrying about additional cost or cash calls for the remainder of the month, we have aggregate accommodation products that guarantee the advance of an accommodation payment as often as you need it within the contract period and within 72 hours. So if you blow through your cumulative monthly attachment point in the first week of a month, we can within 72 hours make an accommodation for that first week, and then your TPA can file additional accommodation requests throughout the rest of that month. So it truly is a product that allows you to write one check a month and then wait and then forget about it until next month. So we're just trying to take some of those what-ifs out of the idea of being self-funded and allow a product to work, and self-funding plan to work much like a fully insured would, with all the advantages of self-funding.
So I mentioned before that at Optum, in the case when a client has a bad claim year, we do have as some up here as well, a rate cap with a no laser option. And what we've introduced last year in the 4th quarter is that kind of the opposite of that is that when they have a good claims year, we have a premium refund option that will give cash back to the client when they have a favorable claims year. So that was just introduced a few months ago. So again, they can have both options. So in a case of a bad year, they can have a cap, no laser, and a good year, they can get premium back.
Montgomery is owned by Companion Life, and Companion Life is one of the bigger carriers in the industry. We offer pretty much everything everybody's talked about up here. The other things that we also offer, and we think we're competitive in, is life, disability, and all those ancillary products that you can bundle right together with your stop loss. So that's something to consider. We've actually been doing a lot of that lately. And I guess on our level funding, which is kind of what everybody's referring to as an aggregate only, but a fully insured lookalike, the administrator hangs on to the claims fund, and the premium just comes to us. And so that gives a little local control to the TPA for those funds instead of sending it to a bank somewhere else.
Right. Great. All right, thanks, you guys. And we're up against it, so I would ask any one of you who are going to be around after the final, we've got 2 more presentations. If you want to kind of come back up here and continue this discussion, we're happy to do that, if you're willing to do that. Awesome. All right, thanks to all of these guys. Appreciate it.